In terms of the private market investments, how big of an allocation is that? Because these investments can be fairly opaque, right? I think Chris Ailman from CalPERS has said it's like a moving bullseye, and you don't know until 3 years later after you've hit it. Plus, they're very expensive.
Right. So we just moved our allocation target to both private equity and private debt. We increased those just back in November. So we're moving from a 13% private equity allocation, moving that up by 4, and then also increasing our private debt. So there is a bit of opaqueness in private equity. These are private companies, portfolio companies, but it's not really opaque to the investor. We can have the same interactions with a GP in a portfolio company that we can have with a public company. So even though the returns on those have been a little slower to, that capital to be returned to CalPERS, we still have a lot of conviction in the private markets, private debt in particular, and also private equity as we've changed really the way that we've implemented private equity. We had a long history of really investing in the large mega funds, the buyout funds, the fund of funds. We are now, with this increased allocation, moving more of that into the co-investment space, which does not have that fee drag that you mentioned.
But you're increasing your allocation in part because you've done so well with those investments in the past. What kind of returns do you expect from private equity and private credit?
So on the private equities part of the portfolio, it's 150 bips above what we would get out of regular passive strategy and public equity. Private debt is something that we have a little more conviction with, and that's ranging somewhere in the 7 to 10, just depending on market cycle.